The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. Here we are, Monday, 4th of February 2019, for session 25 of the Admiral Markets webinar series on mastering the 4Ms of trading. I'm your host, Paul Wallace. I'm a trader, analyst, and coach. And before we dig into the main meat of today's session, as always, we'll just begin with a quick risk disclaimer. Trading with financial instruments offered by Admiral Markets carries a high level of risk which is not suitable for all investors due to their complex nature. Before entering into client agreement or making a transaction, please make sure to read the terms and conditions of our service. Consult a specialist if necessary to ensure you understand the risks involved in trading. This presentation and the accompanying video is for information and educational purposes only. Online education materials are developed by Admiral Markets and distributed by Admiral Markets Group investment firms for a global audience. Therefore, please take into consideration that the information in this session may not be suitable for everyone. As of August 2018, the regulation within the European Union differs for retail clients and professional clients. In our presentation, we use demo trading accounts where all clients could still use a high leverage in a risk-free environment. Before opening a live trading account, please consider the differences between retail and professional trading terms. Retail clients benefit from unlimited negative balance protection. Professional clients at Admiral Markets UK receive a compensation of account deficits with a maximum payout of £50,000 sterling as per our negative balance protection policy. There are many good reasons to trade with Admiral Markets. In particular, you can see that two of their very popular trading instruments, the DAX 30 and the Euro Dollar, have very aggressive competitive spreads during normal market trading hours. They also provide the MetaTrader 4 and 5 platform, along with their own Admiral Markets Supreme Edition plugin. If you have any questions about that or any queries, then please get in touch with your account representative. And it's important to realise that Admiral Markets is a global brokerage, and they are authorised, registered, and regulated in various domains across the globe. And if you speak to your account representative, they'll be able to guide you to utilise the one most suitable for your own trading requirements. So, as always, ladies and gentlemen, I'd like to set our expectations for our session. For me, it's to educate you on the 4Ms of trading so you can go away, analyse any market, be ready to trade it, and also to help you raise your own self-awareness about how you manage risk and manage yourself. For yourself, ladies and gentlemen, I just always say that, I appreciate we always have a broad range of experience in the room. I'm under a time limitation. We have about 45 minutes per session. So that kind of gives us a little bit of limit on the depth of topics that we can go into. But what I try to do is to focus on topics and tools that you can use tomorrow in your own trading so that you can effectively use this in helping and developing your own trading skills and your own trading business. For those of you, most of you will know by now who you've joined us before that, the Mastering the 4Ms of Trading webinar series is about helping educate you about these 4Ms and also, forcing you to consider how you engage with them in your own trading business. Those 4Ms are markets, method, money, and myself. And, after many, many years of trading for myself and for trading for funds and for operating with, probably hundreds and thousands of traders over the years, from retail traders to sort of institutional tier 1 traders, you realize that the traders who do consistently successfully well are very, very good at understanding these 4Ms and in fact are able to master them. And that's what this webinar series is about. It's about helping raise your own awareness about them and helping you develop and master them within your own trading journey. So, that, I'm very big on effectively being the case of, that confidence comes from competence, and that competence is basically, it's a skill, and that comes from effectively from drill. Comes from following good routines, habits, and behaviors. And so from the start of these webinar series, we've talked about sort of building 10 steps that could actually help you sort of develop the correct habits and behaviors for when you look to engage with financial markets. So, regardless of whether you're, a monthly trader on gold or you're a 5-minute trader on Bitcoin, these sort of steps is what we want you to be looking through whenever you open a chart on the markets. And so, go through those. Step 1, we always look at to define levels of support and resistance. Step 2, define if there is a trend in place. Step 3, look to see how price reacts at those key support and resistance levels. At those areas in step 4, look for particular price action signals, and then also be aware of if they're part of a bigger chart pattern. Those were the first 5 steps. This webinar series is in the Admiral Markets YouTube webinar archive, and also on the Admiral Markets Facebook page. So you can go through the all of that series there. It's all there for you to utilize and go through. And what happens is every session we just literally build session by session. Okay, just try and reiterate some of the main points from the previous couple of sessions, because the more times you hear it from me, the more likely it's going to become part of your own trading habits and behaviors, and that's what I want from you. But what we've been looking at now, having done sort of the first 5 steps for the last month or so, we've been moving on towards step 6, 7, and then we'll be moving on to 8, 9, and 10 over the next few weeks and months. So remember, step 6 was all about risk, all right? And we've done this quite a lot over the last few weeks, but it is it's so crucially important. It's about sort of being able to understand risk and money management. Said it many times, right, ladies and gentlemen, you're a trader, all right? It's your job to take risk, and it's therefore your job to manage risk. And the better you become at managing risk, the quicker your progression will be to profitable trader. Brand new traders, all right, brand new traders think it's all about picking a winning trade, or about thinking of picking a superstar trade that's just going to go to the moon, which is nice, but the reality is professionals they're focusing on managing risk, right? And that's what you need to do. Okay, it's about being able to understand and manage risk, and that's what these last few sessions have been all about. Remember what we said is about having just a simple few rules, okay? Simple few rules, all right? Rule 1 is that, you want to be living to fight another day, all right? You don't want to be getting shot down like this guy here, all right? It's a case of that, your trading career should never, ever sort of be based on, 1 or 2 trades, all right? It's about understanding, how to live to fight another day, right? It's about this is not like gambling. This is not like about, playing poker where you have to go all in. Not like that at all, okay? That's not what good traders do. They're always looking to live to fight another day. And you also have to include in that in your rule, okay? Second rule was never ever find yourself in your trade without an exit plan. Sometimes new traders, they can be a bit impulsive. They can see markets moving swiftly, all right? And so they're very keen to sort of pull the trigger on trades, okay? They don't want to miss out. They've got FOMO, all right? Fear of missing out. So they're happy to jump on a trade and ride it. But the reality is that good traders, they never ever find themselves in a trade without an exit plan. You should always know where your exits are, and those 2 exits are pretty simple. All right, know where you're getting out when you're wrong. Know where you're getting out when you're fortunate enough to be right. New traders, as I said, they're always focusing on entries. They're always focusing on where they can get the best trade possible. Whereas good professional traders, they're always focusing on exits. Right. Good professional traders are always focusing on exits. They always want to know, where are the exits. That's just crucial, okay? And you should always know where they are on your own particular trades. So, in terms of, building that into, we talked about position sizing in a few of the trades back, and in terms of what do we have to do about that, is that, we talked about having just simple rules, okay, just a very simple rule of thumb that, you should, in terms of your risk on a trade, you should never risk more than 1% of capital on a single trade. Some people will risk up to about 2%, and, that's okay, but I would say never ever go any more than that. Some people will risk much less than that, 0.5%, 0.25%. For me, some of my intraday trading tends to be around about 0.25%. Okay. Now, admittedly, partly that is also about size of an account, etc. But as a rule of thumb for those of you new trader, if you can just simply stick to never risking more than 1% of a capital on any single trade, well then you should be able to you should be able to sort of honor rule one. Okay, remember rule one is live to fight another day. That's if you're doing that, then that allows you to do that. And we went through that in a bit more detail. Okay, a few sessions back, as I said, they're in the YouTube page, so go and have a look on those. Okay, if you want to talk about, we went into position sizing in particular in quite some depth, showed you how to do it. So by all means, if you're new to the series, then don't be afraid to go back and look at that. So, what we talked about is, for step 6 in terms of managing risks, about preparing your trade. So, you want to, it's important for us to quantify our trade risk. What is our trade risk and how do we do that? Okay. Once when we know where we're getting in, we want to know where we're getting out. Okay. If our trade idea fails, if our trade idea doesn't work out, what's our entry price versus our exit price if we're wrong? That's very often, called our stop loss. And we've touched a little bit about how we can choose a stop loss, and we'll do that a little bit more. Maybe when we go to some of the charts, we can have a little talk about that. So in terms of doing that, that's what we will look at. So there's a sort of, as I'm going, there's a bit of a question from Aaron there about do you have a rule for max leverage? All right. Well, in terms of leverage, okay, that sort of encompasses quite a broad spectrum, Aaron. So what I talk about in terms of trades is that I generally would never ever have more than 6%, okay, of a trading account at risk, what some people would call VAR, value at risk. Within that, I never would have more than 2% of 2% on a position, but a position can be built up from many trades. Okay, if I have a great running trade on, let's say on pound dollar, etc., that might be made up of 4 or 5 smaller trades where I've added to my positions. But then, as a general rule of thumb, so never risk more than 1% on a trade. And actually, I probably trade a little bit smaller than that just because of account size. But then, when you're doing that, then in terms of your actual your leverage, well then that becomes much less of an issue when you're position sizing your trades accordingly. That's the key thing, is to understand how to position size accordingly. And as I said, if you go back a few earlier sessions, you'll find how we talk about how to position size your trades accordingly, so that you're ensuring that you're not risking more than 1% of your account on any particular trade. And if you're doing that, okay, well then in terms of leverage and margin requirements, you should be well within your let's call it well within your parameters. So it's a case of once we want to know where our entry is, where we're getting out when we're wrong, and also a bit of an idea of where we're going to get out if our trade idea works. Now we'll come on to we covered step 7 in particular, okay, about 2 weeks or so ago, but we'll touch on 1 or 2 of the points to reiterate. But we want to have an idea where we're getting in, where are we getting out if we're wrong, where if we're getting out if our trade idea is fortunate enough to be right. And then from that allows us to calculate our reward to risk, and that's actually what we're going to do, the main thrust of the session on today. We're going to get through a few sort of recap slides, and then that'll be the main thrust of our session today, about understanding risk to reward. Okay, some of you will be very natural, some of you might be new to trading, and there might be a new idea, and we will talk about that accordingly. So we're able to calculate your risk to reward once you understand where you're getting in, once you're getting in, where you're getting out, and also where you're getting out when your trade idea works out. Okay, and that's something, as I said, we will touch upon that in a bit more detail a few slides ahead. So to help with that, and a little bit what we talked about, okay, in terms of position sizing. All right, if you can take a screenshot and stick that up on your own sort of trading wall, is that getting an idea of your position size. All right, is and remember, your position size should never be more than 1% of your trading account. That's effectively dividing your trade risk, right, which is where you're getting in, where your entry is, and where your exit is for your stop loss, in terms of what might be the number of pips or the number of points, the number of ticks, depending upon what you're particularly trading, divided by the capital risk. Remember, your capital risk is no more than 1%. So on a £10,000 account, 1% is £100. Okay, on a £1,000 account, 1% is £10. Okay, by being able to divide your trade risk by your capital risk, then that gives you your position size. Okay, and that allows you to determine that what you'll be trading at per point. So that's something that has to become quite natural to you. Okay, quite easy for you to understand and develop. And as I said, it's at first it might appear a little bit daunting if you're completely new to trading, completely new to finance, working with numbers. But realistically, it's actually not that difficult. It's actually quite a simple topic to grasp if once you understand it. But it is about becoming consistent with it. Okay, in all of your trades. Now you'll find that experienced traders, professional traders may they may have a little bit more differentiation in their capital risk. So they might risk 0.25% on one trade, 0.5% on another, 3/4 on another trade, 1% another, depending upon their confidence in the trade, right? But for new traders, it's about building self-trust, right? For new traders, it is about demonstrating that you have the ability to consistently follow some simple rules, okay, some simple rules and procedures which are there for your own safety, to show that you can do that, time after time after time after time. So, as we talk constantly about in terms of the step 6 on the risk, risk management, money management, it's actually one of the simpler topics to grasp. So for many traders, it can be one of the hardest to follow. But what it does by following it, by following it, you can overcome a lot of bad luck, all right, with some proper money management techniques. That allows you, remember, to live to fight another day. That allows you to, stay in the game and develop the skills and experience you need to profit from the markets consistently. And I always say it on every time we talk is that, if you only take 2 things from these entire series is, never risk more than 1% on a trade, never ever trade without a stop loss. All right, make sure that you have both of those elements in place, and then if you do that, well, then you'll always meet rule 1, which is to live to fight another day, and you'll also usually meet rule 2, which is always to never enter a trade without an exit plan. I know that it might sound a little bit simplistic, but it's we're trying to keep this pretty easy, pretty simple, and something so that you can follow it time after time after time after time. That's the really key part. Okay, it's about just having some simple principles that you can just follow every single trade. Okay, that's actually much more important. That is much more important than anything. So if you remember, we did about would have been maybe 2-3 weeks ago, we talked about step 7, which was reward. Okay, so remember, 2 types of exits: we get out when we're wrong, but also where we get out when we're fortunate enough to be right. That's what we know. That's what everybody likes. Everybody likes a winning trade. Okay, nobody can deny that. People enjoy a winning trade. Okay, for lots of reasons. If you boil it down to what are your options when it comes to reward? Well, you either have a target that you're looking to hit, or you'll have what they'll call like a trailing stop profit, which is what we've got there with the old fishing boat with the with the big net trying to harvest more profits. And we talked about it in a bit more detail a couple of sessions ago. As I said, they're on the YouTube page. Targeting, okay, it gives you an element of certainty. It can be hands off because once the trader, you can set it when you set your trade. So that means it takes less time, and therefore there's less psychological or emotional capital involved. There's also less opportunity for interference because you can literally fire and forget. Okay, you can just set the trade and almost walk away from it, just making sure once you made sure that your stop loss and your target are in place. And so human beings, okay, especially new traders where their ego is running amok. Okay, they like to interfere in trades because their ego thinks they know best. They think they know what's going to happen next, and more often than not, new traders are wrong on that. It's easier just to sort of be consistent and almost like fire and forget with your trades. But then, on the flip side, some traders prefer to actually have a trailing stop profit because it allows them to stay with the trade longer, which means that there is a possibility of higher profits, not all the time, but just possibly. When you capture the start of a long, strong trend, well, then there's the opportunity to generate higher profits. Some traders, okay, think that gives them an element of locus of control by having to sort of monitor their trade and actually sort of move their stop profit. They feel as if they're in control. Not really, but they have that feeling of that sensation of being in control of at least their position, if not the market. And so for some of them, some traders find that actually easier to follow. They find it easier to follow their stop profit. Okay. it's that's why they would run with it. But it's, as I said, there is the opportunity for possibly higher profits. When if you're on the fortunate position to capture the start of a new trend that could run for days, weeks, months, maybe even years. But that's the opportunity to sort of, let's say, ride that trend. Okay, that's why some people would like to trade using stop profits. But what I've tried to get across over the last few sessions of looking at reward is that the important thing is that there's no perfection. Okay, there is no perfection. What's more important for me, okay, in terms of a message to get across to you as traders, is that it's more important that you decide on your approach before the trade is even placed. That is actually more important. You'll hear me talk all the way through these series about consistency. Right, people say it's very hard to be consistent without being disciplined, and it's very hard to be disciplined without being consistent. And having some just simple rules that you can follow trade after trade after trade, all right, that is actually more important than trying to find perfection. Trying to find traders will spend all the time, and I've done it myself. You're trying to find the perfect entry spot, where the perfect stop loss, where the perfect target is. You're trying to find the perfection in that, and the reality is that there is no perfection, because markets change, markets move. Not every move in a market is the same. Not every move in a market is made up of the same people. Every moment in the market is unique. So what we're looking to do is just to have some simple principles that guide us, that enable us to operate in a what is in some respects a boundaryless environment, and it allows us to operate that with a modicum of safety in terms of looking after ourselves. So if you're going to use targets, and I say that I tend to use targets. Okay, I personally use targets. There will be other people who will watch this or see this and disagree and say they want to be used trailing, and that's okay. The good thing about trading is that there is the opportunity. There's the opportunity for traders to do well depending upon the approach that suits them best. Personally, as I said, I like to use targets. All right. What I'm going to talk about, and that's actually what we're going to cover more on, is about if you're going to use a target, make sure you have a positive targeting idea. Probably I'd say at least 2 to 1 and above, and I'll touch on that more in the next few slides. In terms of trailing, well, just make sure you have a suitable trailing strategy. And what does that actually mean? Well, that could be very simple. Okay, you can trail your stop profit after. It could be something as simple as a 3-bar trailing stop, whereby for a buy trade you just literally look to keep moving your stop under the low of the last 3 bars, the last 3 candles. It could be something as simple as that, or maybe you use something like fractals, or you trail it behind a particular maybe a number or a moving average. What's more important is that, once again, there's no perfection. It's more about just having something simple that you can consistently follow trade after trade after trade, right? What I very often see is traders, they'll start with one plan. Oh, Paul, I'm going to need a trailing profit on this. I'm just going to trail it behind, every, I'm going to be trailing behind every 5 candles, something, because I want to give that trade the opportunity to move. And then next thing I see, they basically, they've stopped their trade out because they say, oh, well, I had a target in mind, and I just during the trade was going on, and I just decided to close it there because it was in profit. So that doesn't really help you. Okay, so just decide on your approach before the trade is even placed. Build a trade plan. It can be just a simple trade plan. All right, just build a simple trade plan and stick to it. All right, stick to it. And if it doesn't work in that trade, that's okay. That's okay. All right. You want to be thinking in terms of samples of 10 or 20, 50 trades, or even, just samples of that. And how does it work on that after the samples of trades, rather than trying to sort of curve fit and do it effectively for every single trade. Otherwise, that will just draw you. That'll just send you a little bit loopy. So Aaron asks again, how low for the entry point is a guideline for setting a stop loss? And I know not all would be equal. It's a good question, Aaron. So if you don't mind, what we'll do is I'll try and have a little look at a chart or two if there's a couple of minutes left at the end, because it's a bit easier for me to show it on a chart, all right, as a general rule. Hopefully that'll be okay. It just makes it a little bit clearer for people. So I'll try and do that. I'll try and do that for you to answer that question for you. So yeah, as I've just said there, regardless of what you choose, plan your trade and trade your plan. Right? Don't let your reward be decided when the trade is open, or try and change tax once the trade is up and running. All right, have a plan, stick with it, and find something that you can repeat consistently, and that's very simple and easy for you to do. All right, that is actually more crucial. There is no perfection. Okay, there is no perfection. Right, it's trading. Markets are fluid and they are dynamic, and there is no perfection. You just need to be able to simply just put the trade on, manage the trade, manage your risk, okay, and just trade after trade after trade. And I appreciate that is easy for me to say here, or rather than when you're actually doing it yourself. But the quicker that you can embody this way of looking at markets, the quicker that you can embody this way of working, the sooner you'll be able to sort of make progress in your own trading journey. So yeah, a lot of the series over the last few weeks we've talked particularly about risk and particularly about reward, and I wanted to focus a little bit more today, all right, on actually just looking at the risk versus reward, all right, the idea of it. What you're going to find actually, it's crucial in trading, but actually what you're going to find is that it actually it's a reflection. As you think more about it, you'll actually realize it's a reflection on how you actually lead your entire life. Your entire life becomes a series of risk to reward ratio decisions. That might sound a little bit, maybe a little bit cold if you're completely new to trading, but I guarantee as you trade a bit and get some trades under your belt, you'll realize that actually quite often everything in your life is a little bit of a risk to reward ratio decision. So, we'll talk a little bit for a few slides here. How does a trader manage risk versus reward? Right. Quite often you'll hear traders refer to it as the 3 R's: risk to reward ratio. Right. It's about what am I prepared to risk, and for that risk, what kind of reward am I looking for? And this links into let's say a bit of a deeper conversation, which we're going to touch on in one of the future sessions, where we focus primarily just on managing myself, which is about understanding risk profile. That is what becomes absolutely key. And the reality is that it is a bit of a balancing act, and as I just mentioned, a lot of that is defined by your own risk profile. What do I mean by that? Is that we all sit on a spectrum in terms of our view of risk. Okay, we all sit on a spectrum. So some traders are very, very aggressive. So they are very happy to try and take more trades. They're very happy to sort of try and run trades to generate greater reward. Other traders, they're more cautious. Okay, they're more cautious. It takes lots more let's say indicators to line up to give them a trade signal in itself, and also the way they the position size that they place in the market, and also the way they manage their trades. They're much more cautious. If you want to read more about it, if you remember, about sort of 8-9 sessions ago, we did a session on what we call GBT versus FBT traders, right? Greed-based traders versus fear-based traders. I would go back to that session in the archive, and that'll give you a bit of insight into understanding that. What I can say, traders, is that you'll find I can teach you pretty much most things about trading. Okay, and we have here at Admiral Markets. Okay, there's myself and a whole range of other great trading educators who can teach you pretty much everything about trade. The one thing that has to come from you is about understanding your own risk profile, because everybody's risk profile is going to be very, very different. All right. As I said, some will be aggressive, some will be cautious. What I would say is that it's important for you to understand what your risk profile is like, and then actually try and stick with it. If you're a cautious trader, but then you're trying to trade, let's say an aggressive trade plan, maybe you're trying to trade 1 minute charts on on the sort of the Dow Jones or something, where things are happening very fast, very fluid, very dynamic. Okay, then the reality is that is probably not going to sit well with your own risk profile as part of your trading personality. Other people, might be trading monthly charts, okay, and have where there's where you might have trade risk of hundreds and hundreds of pips, because you're trading off a monthly signal, and for those people that might be just too slow, too cautious for them. So it is about understanding your own risk profile. You'll probably have a little bit of an idea of it, But what I can say is, and this is one of the future topics, is by basically ensuring that you keep good records of your trades and understand how you felt, and keeping good journal of your trades, you'll very quickly learn about what your own risk profile is, and it's really crucial to understand that. Okay, it's really crucial to be comfortable with that. So when it comes to trading, what we have is very often there's that old trading adage that you'll hear lots of traders talk about cutting your losses and ride your winners, which is it's easy to say. It's easy for traders to say, okay, cut your losses and ride your winners. But what you find is actually most new traders do exactly the opposite. They cut their winners short, okay, and they stick with their losses. So they cut their winners short because they want to grab at profits. Okay, they want a winning trade under the belt. They want a little bit of extra capital back into their trading account. It makes them feel good. Okay, they feel a winner. There's a little bit of a reward there. Okay, both financially and emotionally. Okay. Whereas they might stick with losses because they think, well, that trade will turn around. Okay, the trade will turn around, it'll come back. I'm just going to give this trade a bit more room to breathe. Okay, and all the messages and the stories that they will tell themselves to show that they don't want to have to accept that they were wrong. Okay, and there's an element of what they call loss aversion bias there, and we're going to talk about that in one of the future sessions. All right, but you'll find most new traders do exactly the opposite. They cut winners short and they stick with losses. So suddenly, let's use some simple sums, okay? On every trade they win, that they because they cut their winners short, they make, let's say they make £10, okay, on their winning trades, all right. But on their losing trades, because they don't want to admit they're wrong, they don't want to admit that the trade didn't work out. Okay, so the trade goes a long way against them. There's no stop loss in place, so let's say they might lose £1,000 on a trade. So they're winning £10. They're winning £10 when they're right, but they're losing £1,000 when they're wrong. And here's the thing: is they will look at that, and the truth of the matter is that you could still be right 98 times out of 100. You could still have a 98% hit rate. Okay, all right, be right 98 times out of 100, but actually still be losing money. Because if you're only winning £10 when you're right, and you lose £1,000 when you're wrong, well then that's no way to run a business. So what will happen is people will do that because they get lots of little gains, lots of little nice hits of dopamine and serotonin and stuff, because they make them feel good, feel like they're winners and stuff. But when they have those losses are big, and that's actually it stops them from having a profitable business. Whereas if you join me on when I do on Tuesday morning, London time, 10 o'clock every Tuesday, we do the real-time daily trading ideas, a quick 20-minute slot on the markets and maybe one or two trade ideas. You'll hear me constantly talking about asymmetric reward to risk trades, right? And why, what is that is? Well, that actually just simply means that, in fact, if I'm going to risk, £100 in a trade, well, then actually, my reward, I'm looking for my reward to be 150, 200, 300, 400, 500, 600. I'm looking to have what they call asymmetric reward to risk. Okay, I want my reward to be multiples of what I'm prepared to risk on a trade. Why do I want that? Well, because it actually removes the need to be right on trades. All right, it takes the pressure off my shoulders. If I know that, for example, every time I have a winning trade, that I generate 4 times my risk. Okay, I have a 4R trade. Well, then it actually means I don't have to be right all the time. Now I know that most people like to be right. Okay, most people like to be right, but the reality is this is a business. Okay. My business has to be profitable. So I look at this as a trading business. So it doesn't really generally matter that much, okay? All right, that much about how often I'm right or wrong. It's about how much do I win when I'm right, and how little do I lose when I'm wrong. Okay, that's the key thing to focus on. So here's a little chart for you, okay? Just a quick chart knocked up, okay? Just to give you a little bit of an idea. So across the top, right here, we know we have our strike rate or win rate, okay? Often we're right, and down the sort of left side, left axis, we've got our risk to reward ratio. So if I'm have a 1-to-1 risk to reward ratio, so I don't know, let's say I'm risking 1%, and 1% is equivalent to, let's say, £100, okay? So every time I risk £100, I make £100. Well, not surprisingly, if you can do the sums, okay, at 20%, if I'm only right 2 times out of 10, then my business isn't profitable. And it's at 50% right that that my business is break even, and it's actually really only from like 51% and above, okay, up towards 60% that I actually am profitable over a sample number of trades, right? So you will see lots of people, lots of people will do that, okay. There are lots of people lots of people actually will let's say risk £100 to make £100, okay. But you have to remember that even with doing that, well, you need to have a hit rate, okay, a win rate of above 50% to do that. Whereas when I'm if I'm have a risk to reward ratio of 2-to-1, okay, if a risk to reward of 2-to-1, okay, so every time I risk £100, I make £200. Well, yeah, not surprising if I'm still only have a strike rate of 20 or 30%, okay, well then I'm going to struggle. But everything from 40% upwards, all right, I start to edge towards being profitable. But I mean, if you think about that, I only need to be right sort of 4 times out of 10. Now, a lot of people, traders, will say, well, Paul, that I struggle with that. I want to be 9 times, I want to be right 9 times out of 10. And that's understandable, and we'll talk about that in a slide or two's time. But what I'm trying to hear is just to give you an understanding that if you have a risk to reward ratio of about 3-to-1, well then actually you only have to be right from about 33% upwards to start to actually be profitable. All right, that means you only have to be right 3 times out of 10. 4 out of 1, okay, 4 out of 1. Well, you're only right 2 times in 10. Okay, with a reward to risk ratio of 4-to-1, well then you're actually break even, and anything above that is profitable. And 5-to-1, well 5-to-1 is effectively a case of from 20% up, you are profitable as a trader. And so that's you're looking at having a good asymmetric reward to risk ratio. By doing that, it takes the pressure off your shoulders to be right. It takes the pressure off your shoulders. Okay, if you have to be right 9 times out of 10 to be profitable as a trader, I can guarantee that actually what will happen is that will be hard for you mentally, and we'll talk about let's say the emotional capital required with that later on as you trade. Everybody wants to be right 9 times out of 10. Okay. Everybody wants to be right. Everyone likes that, but the reality is that if you're going to be right 9 times out of 10, there's a good chance that your risk to reward ratio is probably less than much less than 1. Okay, and that's where you start to struggle. So as I said, I always talk about asymmetric reward to risk, but I appreciate that sometimes they're not easy for new traders to follow. All right, if you, let's say you have you have a risk to reward ratio of about 4-to-1, okay, and you have a hit rate of about 30%. You're actually only right 3 times out of 10, and actually some traders will struggle with that. Okay, and they struggle with that because they actually have more of an intrinsic need to be right than a need to be profitable, right? Which might sound a bit might sound a bit raw, might sound a bit strange, okay? But what you have to realize is that traders, we've all been conditioned by society. We've all been conditioned by society from when you went to start to school at 4 or 5 years of age, all the way through primary school, secondary school, into university. That in tests you were always deemed looking to get 7 out of 10, 8 out of 10, 9 out of 10, 10 out of 10 in your tests. If you did, you got rewarded. Whereas if you got 2 out of 10 or 3 out of 10 in your school tests, you were deemed to be not to be not terribly clever, and that meant you sort of got detention, or you got extra homework. Okay, and we carry that conditioning into the rest of our lives and into our trading. So we come to trading, we want to be right 6, 7, 8, 9, 10 times out of 10, and that's actually the thought of being right 2 times out of 10, 3 out of 10, 4 out of 10 is actually can be very, very challenging for new traders, because emotionally it means that they struggle, because it means that you might have a cluster of losing trades. Okay, you could have a cluster. You could have 4, 5, 6, 7, 8, 9, 10 losing trades on the trot. That is the possibility. And and that is that can be quite challenging for a trader. That can be quite emotionally draining for a trader. So Aaron talks about how you're managing the downside in risk and the higher end of the risk reward ratio, especially when you get into 4 to 5 to 1. Okay, in terms of the downside risk on the higher ends. Okay, in terms of the downside is that's the downside risk is effectively you should be positioning sizing still very small as we talked earlier on. You should also effectively be making sure that you have things like your VAR, so there's no you have no more than sort of 6% at at risk at one particular time, and you'll also have you'd have rules about if you had a certain number of losses or percentages down within your trading plan that would enable you to effectively make sure that on a bigger picture, on a bigger scale, you're always looking to live to fight another day. So it's a case of say that if when you write 2 times at 10, don't you need to hit big home runs? Well, that's what if you have a reward to risk ratio of 5 to 1. Okay, well then you can be right 2 times out of 10, and then invariably you can do very well out of that. People talk about do that. Most, let's say, new traders, they want to be right 9 times out of 10. But the guys who are billionaires from trading, right, and here's the learning point, guys who are billionaires, people like Paul Tudor Jones, people like George Soros. Paul Tudor Jones talks about, him being right, having, him being right about 25% of the time. Okay. And he has a risk to reward of about 5 to 1 on his trades. George Soros, he's normally right about 1 in 10. Okay. On his trades. All right. He's right for 1 in 10, but he's looking to have a 10 to 20 reward to risk on his trades. And all of those guys who've done that, they are billionaires. So they must be doing something right. Okay, they must be doing something right. So it's a case of it's understanding your risk profile in terms of some people just will really struggle and need to be right all the time, where other people will be comfortable recognizing that they might not be right all the time, but actually they have, because they have asymmetric reward to risk ratio that allows them to over let's say 10 trades, 20 trades, 50 trades, 100 trades, that they are profitable. And it is about finding a little bit of a balancing act, as we said at the sort of first slide, a little bit of a balancing act about where you sit and where you're comfortable on that. So don't be surprised that as new traders, as I said, they want to be right 8 times, 9 times, 10 times out of 10. But actually, as you become more experienced, as you grow as a trader, as you become more comfortable, then actually it's very often that you can find that your reward to your hit rate might drift downwards, but actually your reward to risk ratio drifts upwards, because your ability to read trends, your ability to enter trades, your comfortableness with actually letting a trade run, that will all change as you develop and grow as a particular trader. So I hope that gives you a little bit of insights there, Aaron. Good questions. I appreciate that. So I think we've got a couple of minutes left. So I'll just quickly a couple of minutes. So we've covered mostly risk management and trade management for 2019 so far, but we'll also be moving across to sort of looking really about managing performance, how you recover from a bit of a slump, how you improve your performance, and as we go through later on in the year, we'll talk about sort of short-term trading and some advanced trading tactics. For yourselves, ladies and gentlemen, as always, I always end with, remember to manage those 4 M's of trading within your own trading business. Okay, how are you at managing markets, methods, money, and myself? Are they in alignment? Are you on top of your game? Because when you are, that's when you tend to trade well. If you're having a bit of a trading challenge, well then just quickly understand where is it, okay, and what part of your 4 M's is it? Is it a case that you have a trend following method, but the market environment is range bound at the moment, which means there's no alignment there, so you're gonna struggle, or perhaps maybe you're risking too much. Maybe you're over trading in terms of your number of trades, or you're risking too much in terms of your position size, so you're not comfortable in your trade, so you're snatching at your profits because you're a little bit anxious. Okay, so if you're having a bit of a challenge, I can guarantee that the answer will be in one of those 4 M's, and it just takes a little bit of a quiet reflection and study of your trading data to help you. So if you have any questions, if you're watching this on demand later on, or you have questions later on, if you've been watching this and you want to, have a chat to someone about it, you can always, get in touch with the Admiral Markets London office. The London number there, 02077264003, or you drop them an email at hello@admiralmarkets.com. As I said, all the previous sessions are on the youtube.com/Admiral Markets page. They're also on facebook.com Admiral Markets Global page there, so you can go through all of them to your heart's content. As I said, every session we just move on. We have a little bit of a recap and we move on, because as I said, the more times you hear it from me, it's like osmosis. The information, the habits, the behaviors, I want them to sink into you. Okay, I appreciate it. Sometimes these things happen a little bit slowly, and so just recap and build and build and build, so that you're getting the right idea. So I'll just quickly have a bit short time, but I'll have just for a couple of minutes, just have a quick look. Aaron asked about, how low from an entry point for setting a stop loss. If you'll bear with me a moment, I'll just try and switch across some charts, and we can have just a very quick look to sort of finish up the session there. So just bear with me one moment there, and we'll just click across to the Admiral Markets MetaTrader charts. There we go. We'll bring that up. So let's have a look. So okay, so this is actually a trade we talked about last week. Okay, so here we had a trade last week that was a trade from about 2 weeks ago, and we talked about it. Okay, it was about trading a key reversal candle. Okay, which we talked about in one of the much earlier sessions, when we focused primarily on markets and methods, and we had an entry here around about 109.69. And in this particular case, I want to put my stop above the high of the candle. Okay, so in this particular case, the high of the bar was 109.99. All right, 109.99. Okay, so and the 109.99 and the sort of the spread. Okay, the spread is is about 1 to 1.5 pips on the dollar yen. So as a general rule, okay, if I'm sort of trading sort of 4-hour charts and below, what I'd be looking for is to effectively just put my stop. If I'm going short, my stop would be vary about sort of 2 pips plus the spread above the candle. All right. If I'm trading sort of daily and weekly charts, well then I'm looking at being sort of between 5 to 10 pips plus the spread. All right. Just because it's a bigger chart. All right. Sometimes it can be a little bit of just want to make sure I'm not sort of caught out by any kind of slippage or very quick stop hunting on the bigger charts. But on the short term, 4 hours and below, I'm just normally looking for sort of especially on the short side, I'd be just because your charts are on the bid, on the sell. I'll be looking at the sort of 2 pips plus the spread. That's where I would normally be putting my stop loss on the other side of the candle, or if let's say for example I was looking here for the fractal, and I wanted to put it here, and the low of that is 109.14. So I'd be looking at just putting that the sort of my stop would be at 109.10. So that's literally sort of 2 pips plus the spread beneath it, just to make sure that I am covered there. So there you go. I hope that helps. I hope it just gives you a little bit of insight. We'll touch more and more on this as the sessions go on, and we move more away from slides and more onto charts. We'll be able to look at that and talk about that, and we will talk about that. So for those of you, as I said, Tuesday mornings, 10 o'clock London time, okay, is the real-time daily trading ideas. By all means, come and join me. Alternatively, I hope you have a great trading week, and I look forward to seeing you next Monday, 4 o'clock. I hope you have a great trading week, and I'll speak to you soon. Thanks very much. Rolf says, thanks, Paul. Your webinar really helps. I'm looking forward to tomorrow. That's great. Thank you, Rolf. I appreciate it. Phil says, thank you, Paul. That's very kind of you. That's very kind of you, Phil. Thanks very much. Have a great trading week, everybody. And I'll speak to you soon.